Are you planning to buy your dream car but just don't have enough money saved for it? A good car loan can help you change your dream into reality. This video will give you all the information you need when considering car loans. How does a car loan work? 6 things to keep in mind when looking for a car loan. 8 tips to get the best car loan. What is a car loan? A car loan is a loan taken out for the purpose of buying a motor vehicle, such as a car, ute, 4-wheel drive, motorbike, or another road vehicle. A car loan can also be called a vehicle loan. If you don't have enough in savings to afford to buy a car, but you can afford to repay a loan in monthly installments. How do car loans work? When you enter a contract for a car loan, the amount of money you borrow has to be paid back within a certain period of time, called a term, usually in regular payments. The length of the term can vary, typically from around 12 months to 10 years, depending on the lender you choose and the agreement you reach with them. In addition to requiring you to pay back the amount you borrow, lenders will also charge you interest on the balance at either a fixed or variable rate, plus any fees and charges. What are the things you should keep in mind when looking at car loans? Compare loans before you meet the seller. Here are a few things to compare. 1. Types of car loan. New car versus old car. 2. Comparison rate. 3. Types of interest rate. Fixed versus variable. 4. Type of loan. Secured versus unsecured. 5. Fees and charges associated with car loans. 6. Loan term. 1. Types of car loans. There are 2 main types of car loans. 1. New car loans. Available for buying cars that are brand new, and some lenders will let you use a new car loan for a car that is 1 or 2 years old. Typically, a new car loan will be secured by the value of the car. New cars are generally worth more than older models, so you might be able to negotiate a competitive interest rate. 2. Used car loans. Available for buying cars that are too old to qualify for a new car loan. Again, a used car loan is usually secured by the value of the car. If a car is more than 5 or 6 years old, it might be too old to qualify for a used car loan, and you'll have to apply for an unsecured car loan, an unsecured personal loan instead, which can attract a higher interest rate. 2. Comparison rate. The comparison rate is designed to let you easily compare the true cost of one loan versus another. There are so many fees involved with every personal loan, and it can be very confusing to decide which one is the most affordable for you. Comparison rate is calculated by combining the loan's interest rate with other costs and fees involved. Like the interest rate, it is shown as a percentage of the amount being borrowed. On top of the interest rate, a loan's comparison rate will factor in things like any establishment fee that's charged when you take out the loan, ongoing fees you might pay throughout the life of the loan, the amount being borrowed, the duration of the loan, how long it will be paid back over. Comparison rate gives a truer picture of the cost of borrowing than the interest rate. There are other things to consider. 3. Types of interest rates. Variable interest rate car loans. A variable interest rate loan is a loan in which the interest rate charged on the outstanding balance varies as market interest rates change. As a result, your payments will vary as well, as long as your payments are blended with principal and interest. Variable rate car loans usually don't have an early exit fee. This might be better if you're planning to make extra repayments and pay the car loan back early. Fixed interest rate car loans. Fixed interest rate loans are loans in which the interest rate charged on the loan will remain fixed for that loan's entire term, no matter what market interest rates do. This will result in your payments being the same over the entire term. Whether a fixed rate loan is better for you will depend on the interest rate environment when the loan is taken out and on the duration of the loan. Which is better, fixed interest rate or variable rate loan? This discussion is simplistic, but the explanation will not change in a more complicated situation. Studies have shown that over time, the borrower is likely to pay less interest overall with a variable rate loan versus a fixed rate loan. However, historical trends aren't necessarily indicative of future performance. Your credit score affects your auto loan. One of the main factors lenders consider when you apply for a loan is your credit score. A higher score can help you secure a better interest rate, which means you'll have a lower monthly car payment. 4. Types of loan. Secured versus unsecured loan. Secured car loan. When you purchase an asset like a car, a secured loan takes this asset's car worth as security. This means that if you couldn't repay the loan, your lender would be able to sell your car to get back their money. A secured loan generally makes it less risky for the lender, which means you may be able to access a lower interest rate than you would with other loan types. As with any loan type, it's worth checking the interest rate and calculating your loan repayments to avoid any surprises. If you take out an unsecured car loan, you don't have to put up an asset as security. However, since the lender may be taking on more risk, the interest rate could be higher than it would be for a secured loan. 5. Fees and charges related to car loan. As the good old saying goes, nothing in life is for free. Unfortunately, this applies to car loans. A lender won't miss you when it comes to fees and charges. Application or establishment fee. Also referred to as a setup or startup fee, an application fee is a one-off payment when you open up your car loan. Break cost fee. This is a charge or penalty you will receive when you pay off the full amount of the loan before the term is over. A break cost fee usually applies to a fixed-rate car loan. Ongoing fee. The idea of an ongoing fee is to keep your car loan alive. It may refer specifically to a maintenance or annual fee. It is paid throughout the loan term. Statement fees. The cost to have your statement sent to you. Discharge fee. Also known as a closing fee. A discharge fee is charged at the end of the loan period to cover costs of terminating the account. Late payment fee. If you fail to make a repayment on time, you'll be charged a late fee. Early payout. If you default, transfer, or pay off your loan before the end of the term, you'll be slapped with an early payout fee. 6. Loan term. How long do you want the loan for? To a certain extent, your loan term will be dictated by your repayment ability, but you should try to choose the shortest loan term that you can comfortably afford. The longer your loan term, the more expensive the lifetime cost of your loan will be. Let's take an example of a $10,000 car loan with a comparative interest rate of 12%. Comparative rate equals interest rate plus all the fees plus all extra charges. If the loan is taken for 5 years, we end up paying $13,347 for a $10,000 car. Not too expensive, right? But if the same loan is taken out for 10 years, we end up paying $17,217 for the same $10,000 car. That is $7,217 extra? Is it worth it? Now that you have understood what a car loan is and how it works, let's look at some ways to save money on car loans. 8 tips to get the best car loan. Aside from choosing the right type of car loan, there are also other ways to get the best loan for your car purchase. Make sure to own a good or excellent credit score before applying for a car loan. It will allow you to negotiate for a better rate with lenders. Don't just settle with the bank or credit union nearest you. Shop around with as many lenders as you can to find the best car loan deal you can have. Many lenders give better car loan deals if you have a cosigner. Just like the collateral of a secured loan, the cosigner will also serve as security to the lender. That's because, in the instance that you're unable to make repayments, the cosigner will be billed in turn. This lessens the risk for the banks and credit unions, allowing them to offer the best loan deals to borrowers. Save up for a bigger deposit so you'll need to borrow less and get a better rate. Find a lender who offers a pre-approved car loan. It will enable you to know exactly how much you can borrow, which will help you shop around confidently with dealers. Avoid add-ons. Paint sealant, fabric protection, tinted windows. We've just named 3 things that will provide you with the next to no tangible benefit but will put hundreds of dollars in the hands of your car dealership. Do away with them and reduce the size of your loan by a notable amount. Be prepared to haggle hard. It may not be evident, but the reality of car finance is that absolutely everything is negotiable. This includes the cost of the car and admin fees that may seem fixed. The dealership makes no money if you walk away, and you'll be surprised how far they're willing to bend to stop that from happening. Be smart with your timing. There are times of the year when cars are cheaper, and not taking advantage of this fact is a fool's error. The end of the financial year is an obvious one, but you can also save major dollars around Christmas and the start of the new year. Thank you for watching this video, and we hope now you have all the information you need to buy your next dream automobile. If you did not understand anything particular in this video, please leave a comment below and we will try to make a short video about it. Stay connected and we'll see you in the next video.